This is a Financial Literacy Learning Center video. A potential loss in your investments over the next 5 to 10 years due to investment style. Don't become a victim of the pie chart. If you own a balanced, conservative, very conservative, income and growth or growth and income portfolio of stagnant mutual funds or ETFs, then this video must be watched. It's important to your wealth going forward. Terms of use and disclaimer. The content of all videos or articles produced by Financial Literacy Learning Center are for educational purposes only. All ideas, opinions, and or forecasts are for informational purposes only. It should not be construed as a recommendation to invest, trade, and or speculate in the markets. We believe in the use of investment professional before investing. Not all advisors are alike. We can assist you in matching advisors with what you may be looking for. We strongly believe that the majority of investors require assistance from an investment professional. We hope you review our video on the investment industry to be fully aware of all the various licensed investment professional types in Canada, along with their fees and or compensations, as well as their services. What is so concerning about this pie chart? Well, not a lot. It's colorful, round, uniform. It looks organized and could be used to demonstrate discipline. From an investor's perspective, it can conveniently give an impression of customization and a lot of hard work and insight. It may also appear rigid, unadaptive, and could create a great assembly line-like sales environment that allows minimal financial licensed individuals to mass sell products with little time, effort, and maintenance, all at fairly high fees. There are plenty of MFL teams out there. Well, let's be fair. Sitting in front of a person and answering a series of questions that results in an outcome of one of 5 to 6 pie chart investment portfolios has generally not been a bad experience over the last 20 to 30 years, if you held on. It is also important that your financial company that you placed you in the pie chart portfolio held on with you too, because hundreds of mutual funds and wrap accounts have disappeared or consolidated over the last 30 years. Why was it generally a positive experience? Interest rates, specifically bond interest rates, have fallen continuously. Follow this short video to explain further. It is important to learn because the way investing is practiced may turn upside down. Remember the movie Back to the Future? Well, it may now become We're Going Back. A bond primer. We recommend that you go to the CIC investment course box at the right side of our website and click on it to enter the free investment course. Go to the fixed income lesson that explains how bonds work. If you are an investor, this is very important to understand. Go to the next slide for bond price movement examples. Here's some bond price movement examples. Example 1. A bond that matures in 10 years. It's purchased for $100 and has a coupon yield of 3%. What is the price of this bond if 10-year yields go up to 5%? Your answer is that the bond price falls to $84.50, which results in a 15.5% capital loss. Example 2 is the same purchase price and coupon yield, but the bond matures in 20 years. What is the price of this bond if 20-year yields go up to 5%? The answer is the bond price falls to $75, which results in a 25% capital loss. What is the price of this bond if the 20-year yields go down to 2%? The answer, the bond price goes up to $116.35, which results in a 16.35% capital gain. Now you know how a bond fund that has an internal portfolio yield of 2.75% with a 1.25% per year in MER fees, please go to the lesson on mutual funds and fees, can manage to earn you 5% plus in a year. Interest rates generally must always fall or you lose or earn nothing. So let's summarize. Interest rates go up, bond prices fall, and vice versa. Bond prices become more volatile, increase as bond maturities increase, and vice versa. Let's later look at what bond yields have done in the last 40 years, and you can decide how much more rates can fall. It's this factor that places the balanced fund or the buy and hold strategy in question. How do the future direction of interest rates affect pie chart, buy and hold investing? Use a balanced portfolio as an example. Balanced portfolio example. Interest rates across the entire yield curve are at all-time historic lows. They're either going to go back to normal or go sideways. Balanced portfolios are typically made up of 60% equities and 40% bonds, usually in the form of mutual funds. They can be made up of ETFs or individual securities and wrap accounts as well. So here's a balanced portfolio expected return over the next 10 years. The portfolio is made up of 40% fixed income, which are bonds, and 60% equities. And we've expected an annual return of 2.5% on the fixed income and 7% on the equity side. And 7% may be a pretty generous return assumption. However, the bond return assumption is pretty standard. The 40% fixed income contributes 1% to the overall portfolio return, and the 60% equities contribute 4.2% for a total expected return on the portfolio of 5.2%. However, this return doesn't take into account fees. Typical fees for a portfolio like this using mutual funds of wrap accounts are 2% per year. So your total expected return minus your fees is 5.2% minus 2%, which equals 3.2%. And that is mostly all risk. In this example, the fees have removed 40% of your total return. You're much better off buying a high quality rate reset preferred share. Please go to the CIC course to define preferred shares. These preferred shares yields exceed 4.5% per year. We don't want to bury our heads in the sand and pretend everything is historically normal. These are very unusual times. Ask yourself, where are interest rates going in the future? Look to the slides that follow on historic interest rates and you decide. Don't ignore what we have just covered and pretend the past will never repeat again. Do you really think that the 10-year interest rates will fall to the -3 to -4% area from 2% today in the next 5 years? That's what you need to repeat the same experience that a balanced portfolio just performed in the last 10 years. Do you really think that will happen? Most asset classes gravitate to normalization. In other words, they go back to normal. It may require a 100% increase in 10-year bond yields from 2% to 4% for a normalization to happen. Nothing conservative about that. If you believe that interest rates are not unusually low and will never rise again, then a buy and hold strategy will work. And there are lots of MFL pros that are adequate for this. We practice the buy and rule approach for handling a balanced portfolio to help protect investors from future rising rates. Please refer to rules-based investing in one of our free lessons. Although buy and rule requires more work, fees to you are lower in most cases. Here's a graph of Canadian 5-year interest rates dating back to the mid-1970s. As you can see, the high in the graph, around 16%, was in 1981, and there's been a steady trend down to where we are today, down to historic lows that are lower than those of the 1930s during the Great Depression. Would you want to lock in this rate? Here's a graph at the same time period of U.S. 30-year bond yields. The Canadian rates follow a similar pattern. As you can see, the same general trend persists. Steady downward all the way until where we are today. And here's, for a big-time historical context, is the U.S. 10-year Treasury yield, dating back to the 1790s. As you can see, things are usually quite steady, and again peaked around the beginning of the 1980s and have slowly worked down to historic lows that have really only come close one other time. Here's an exercise. Fill in the blanks using the 4 terms below the pie charts. The green, fixed income, is bonds and or debentures, and debentures are high yield or junk bonds. Ask your advisor to complete this exercise too. There's conservative, aggressive growth, and balanced. Based on this lesson, what do you think truly is conservative and what truly is aggressive? Interest rates affect stock markets too. You must practice rules-based investing in rising interest rate environments. As you can see, this is the gray line represents a similar chart to what we just looked at for 5-year Treasury rates, slowly gone down to historic lows, and over the same time period, the S&P 500 index has gone steadily up.